now we'll quickly prepare the stage for our next session, which is a panel discussion titled Navigating Challenges, Embracing Opportunities, the Road Ahead for the Mutual Fund Industry. This session will address the numerous challenges and opportunities facing the mutual fund industry today and provides insights into future trends and strategies. The panel will cover several topics, including advantages of investing in mutual funds, an outlook for debt funds, the role of ETFs in portfolio diversification, the future of hybrid funds in emerging markets, challenges in the mutual fund industry such as reaching out to retail investors, internal and external factors affecting mutual fund performances, new fund houses, their challenges and scalability, implications of the removal of indexation benefits for debt-oriented saving plans, and tax issues in the mutual fund industry. And we'll start the session in next 30 seconds. I request all our delegates to please be seated and kindly keep your phones on silent mode. The panelists for this session are very much inside the hall, and we are starting in no time. Post this, we have also planned one more panel discussion, and then we'll finally conclude with lunch. I once again request our delegates who are standing to please be seated, as we are starting in no time. Ladies and gentlemen, our stage is all set, and we are all ready to begin our next panel discussion. Please join me in welcoming session moderator, Mr. Gaurav Dikshit, Director Ratings, Care Edge Ratings. He'll be moderating the session. A very warm welcome to you, sir. Once again, a very warm welcome. Can we all please welcome the session moderator? And now let's welcome the eminent panelist. We have with us Ms. Sheila Kulkarni, Head Market Development and Institutional Investor Relationship, WGC, joining us once again. A very warm welcome to you, ma'am. Kindly keep the applause going. Mr. Umesh Kumar Mehta, CIO, Samco Asset Management Private Limited. Mr. Chirag Mehta, CIO, Quantum Asset Management Company Private Limited. Mr. Rohit Kumar, CEO, Optimus Financial Solutions Private Limited. Mr. Jeetu Valecha Sonar, Fund Manager, Kotak Mahindra Asset Management Company Limited. Mr. Anuj Gupta, Head Commodity and Currency, HDFC Securities. Let's once again welcome the eminent panelists, the learned speakers. Thank you very much for joining us, and I now hand over the session to session moderator, Mr. Gaurav Dikshit, for further proceedings. Also, I'll request Mr. Dikshit to please keep track of the time as we are running behind schedule. Over to you, sir.
Thank you. Great. So we are all set. To begin with, as we all know, over the past decade, the industry has seen a five-fold increase in assets under management, thanks to better investor awareness, favorable market conditions, and diverse fund options. Well, the returns are there for everyone to see. Umesh, coming on to you, with your expertise and experience, what's your perspective on the current state of the mutual fund industry? And any highlight, anything which you like to highlight in terms of key trends you believe which are going to shape its future?
Yeah. So today, mutual fund industry is where banking industry was 15 years ago. So over a period of time, we have seen lending, housing finance companies, your NBFCs, your gold lending, your MSMEs, your microfinances, from a traditional lending space to various ancillaries. So this is the moment of mutual fund. Mutual fund industry is transitioning from asset gathering to asset management, from traditional investing to strategy-driven investing. And this is how I think there is massive scope for innovation. So for 40 years, this industry is large, is an evolved industry. So today a newer fund house like us, so we were able to bring first of its kind momentum strategy in India. So there is a scope of a lot of innovations, a lot of strategies that will come for investors, those who understand. So I think, yeah, the depth of the industry will get bigger and bigger going forward.
That's great, and that's, I think, music to ears. It's something which everyone is looking forward to, and I think that compounding has played a major role in that. As you said, the industry is where banking was some years back. Coming on to you, Chirag, in terms of significant advantage, how do you see investing in mutual funds better than the asset classes? What are the advantages which you'd like to highlight?
So the question is that vis-a-vis direct investing, how mutual funds add value to the investors, right? So firstly and foremost, it brings a very professional, disciplined approach to investing. Like unlike people get, moved by the moods and sentiments that are there in the market, which is not with the mutual fund managers. We know there is a team, their job is 24/7, look at how they invest, how they research, and then they build portfolios out of it. So first and foremost, it's very, very professional, disciplined investing that mutual funds bring to the table. Second, and very important, is the tax efficiency that we bring to the table. So one is creating long-term money, long-term wealth for investors. At the same time, it is very, very tax efficient, because when we buy and sell stocks and there is a capital gain made, there is no capital gain incidence on the investors. Only when they redeem, they have to pay a capital gains tax. And hence, it is a very good way to invest rather than investing on your own. Third is to give products, right? It gives solutions to investors' needs. Investors may have very diverse needs. They craft portfolios to suit needs of risk and return for every type of investors. Everyone wants to understand diversification, right? Everyone wants to build an asset allocation. So today you can choose a portfolio or a fund which is designed to meet your asset allocation requirements. Some may be conservative, some may be aggressive. You can, choose one product and you can diversify across asset classes by just investing in one. You need not track multiple investments, you need not track multiple NAVs, need not transact in many things at one go. You just invest in one fund, you are taking care of all the investor needs that you need from that investment. So that's another biggest advantage. And as I said, solutions, right? So there are many solutions being designed by the mutual fund industry which are very, very useful for investors. For example, in the offshore markets, in the markets like US and others, there is something called a manager selection strategy, which is called as equity fund of funds, right? In that, you have a fund manager choosing other fund managers. And hence, it is a very good way for investing, which is not so much prevalent in India. Say you are an advisor, a mutual fund distributor, you want to allocate time to gathering more clients, you want to take time to build their asset allocation that suits them, but within that, what to buy, you can just outsource it to the fund manager. So there is lot of things, and again, it's very, very tax efficient, because when you buy and sell funds for the clients, there is a capital gains incidence again. But when an equity fund of funds changes funds within that, you don't pay taxes for that. So there is a lot of advantages, right from professional approach that you get, disciplined approach you get, and tax efficiency and products that suit your requirements. So there is a good package that you get when investing in mutual funds.
Right. No, that's correct. As in terms of tax advantage, in terms of the options which you get, the diversification which you get, I think all those things lead to the attractiveness of this investment options. Sheila, coming on to you, how do you see the performance of the alternate asset classes? Because amidst the recent government moves to make taxation more uniform across different asset classes, specifically, could you elaborate more upon the gold mutual funds and the gold ETFs? Because that's something which is your expertise.
It's a very good question. I think, last year, somewhere in April, what the government did was club gold ETFs with debt mutual funds. And that created a disadvantage for people who were looking at moving from physical gold into investable gold through gold ETFs or gold fund of funds. What has happened this year in the budget, the government has actually changed the tax structure, and it's a fantastic structure, because now gold ETFs are treated at par with equities. So which means that if you hold an equity fund or a pure equity stock for 12 months, you get about 12.5% taxation. And with ETFs also, it's the same thing. So bringing it on par with equities has been the best thing, because as a diversifier, you're not just going to put all your eggs in one basket, i.e. invest just in equities. If you're looking at a diversifier without the headache of the added tax burden, the government has actually taken that burden away.
Yeah, that's correct. So, Jitu, coming on to you. It's on? Yeah. So, as Sheila was pointing out, in terms of the alternate asset classes, how do you see ETF contributing to the portfolio diversification? I'm talking about the overall ETFs compared to the traditional mutual funds.
Yeah, unlike the normal traditional mutual funds, ETFs also have the same properties. Like they are also invested by, managed by some asset managers. But in traditional mutual fund, they try to outperform the indices. But in case of ETFs, they normally try to be with it's to perform near to the indices and to perform in line with the indices. And ETFs can be a good option if an investor don't want to have, and if there's a new investor, he don't want know how the fund performed in the in the past. So in case of ETFs, they just what is it? They invest into the indices. For example, Nifty has performed well from last 10 years. They have given good returns from last 10 years or whatever you say. So that's, and ETFs are cost efficient if you compare with the normal funds. So maybe in the normal funds the expense ratio is around maybe more than 1.5%, 2%. In ETF it's around 50 basis point. So that will also that is also yeah.
So in a way, it's a good strategy to begin investing in terms of being cost effective, in terms of being less risky, better return offerings. How do you see that as a initial investing opportunity for a new mutual fund investor?
So as a new investor, they can the ETFs are actually listed on exchange. So anytime they can check the NAV or whatever the performance, how it's performing, you can check on the exchange and buy and sell on exchange. So in case of that normal mutual fund, you will get the whatever the NAV or whatever at the end of the day.
Okay. That's great. Yeah, Anuj, coming on to you, in terms of alternates, in terms of options, in terms of various asset classes which investors can invest into, how do you see the hybrid funds and what kind of opportunities do they present to the investors in emerging markets? And any trends or innovations do you foresee in the development of hybrid funds in these markets over the next decade?
Yeah, see, I will take it from the example of hybrid cars. Now, everyone among us like to drive hybrid cars because we want to maintain the average and the speed. So, in that way, for the investment, hybrid funds, are very important. And in that manner, we have seen now all global market is running behind the uncertainty. So in that sense, hybrid funds are liked by the investor. So if we saw the data, almost you can say 7 lakhs crore AUMs, including the hybrid funds, and apart from that, most 6 crore lakhs AUM comes from the individual side. So people are like to invest in the hybrids fund in spite from the equity fund. So people are, as we are talking about the diversification, so it is the only product where you can diversify your fund, 50% in equity and 50% in bonds and other things. And the hybrids funds, we have seen a sharp increment in the folios always, almost 39% folios increase in the hybrid fund. So in that current situation of the global market, people are like to invest in the hybrids fund, and we are expecting that further people will invest in the hybrids fund. Not hybrids fund, now people are also like to invest in the gold ETF, which is also the part of diversification. So when we talk about diversification, these funds are people are looking to invest in these kind of fund, and I am sure that after the 5 years when we look after, so people will more invest in the hybrids fund. And I think as we are from SDFC, so we are also promoting this kind of funds to invest, to diversify the portfolio.
No, we have seen, actually, you're right, we have seen a lot of traction in hybrid funds and the kind of taxation rules which have evolved over the period. I think that sector, that segment of the overall mutual fund ecosystem looks quite promising. Coming on to you, Rohit, we see customer is always demanding, and in your opinion, do you think with increased use of technology, AMCs still have the capacity to be more cost effective, which can be, which can lead to reduced expense ratios and make it much more attractive and rewarding to the investor?
Certainly, the AMC can reduce the cost, but then issue will be MFD will get less return.
less charges, brokerage, then who will work? Do you think directly we can reach out to 140 crore people? It's not possible. So, looking at reducing the cost and not passing on to distributor MFDs, the growth will affect it.
Okay.
Second thing, when you are talking about technology, there are 2-3 mutual funds who have been recently launched schemes. Grow is one of them. Virodha is one of them. In that, if investor has some query, so they are directed to call center. Press 1 for this, press 2 for this, press. So investor is not getting what he wants.
True.
But in case of MFD, when it is a face-to-face interaction, the investor gets comfort. And he gets answer of all these questions. If some investor wants to ask, that is not possible in Grow. And so, in my view, technology is just we have to start. It will take long time. But we have to depend on MFD, and technology will not take up entire thing. As far as cost is concerned, what you said, there are exchanges where we do transaction. Then there are AMC's own website. Then there is a MF utility. Since I was on the other side of where I am now,
True.
I have served mutual fund industry for 2.5 decades. The charges this exchange they are charging, that charges if you are able to save, then we will be able to reduce the cost. Because I have seen, we have bargained also, but the exchange going through them, they have minimum fee. If I don't do X number of transaction, that is not cost effective. So I will still say that technology is not the exact answer what we are looking at to reduce the cost.
Okay. So basically, tech is something which can be a beginning point, but to say that tech will lead to a lot of cost reduction and that can lead to much more traction in the sale, that looks unlikely at this point of time.
See, we have to incentivize MFD's effort also.
True, true.
If you reduce the cost, you will not be able to pay. And then this kind of geographical reach India has to reach out to everyone, we need MFDs. We need
that needs to be incentivized, that needs to be promoted to ensure that the penetration keeps on rising.
See, investor will trust local people.
True.
That local touch will be there. But whereas through technology, whatever products are there, yes, young generation are now getting into that. And there is a herd mentality, WhatsApp gyan, Facebook gyan that is happening, which is actually misleading. It doesn't help. And today in the morning when whole-time director were saying that mutual fund, while selling you should do the risk profiling and suggest the right product. On the other hand, 3 or 4 years back, we were called as a independent financial advisor. Then SEBI said, no, you are not the advisor. Change your name, MFD, mutual fund distributor. Means we have to just facilitate the transaction. But he mentioned you do the risk profiling. He mentioned that you suggest a good scheme. Do you know today how many NAVs are there? 4,440. Out of this NAV, you have to select one NAV and give it to that individual. You can do. Investor can't do this.
True. You're right. I think these will be the challenges which we'll see going ahead.
Lot of challenges. Regulator on one side said you can't keep your name as a solutions. On the other hand, he says you sell. The day before yesterday, I believe, a week before, Madhvi Buch was on a dais and she said Motilal Oswal is a... It was like a branding Motilal Oswal. As a regulator, how can you say one company's name? Whether it is a good or bad, let advisor decide. Na? On a big platform, SEBI chairman is saying Motilal Oswal is a... So that is wrong.
No, that's something which can be seen. Umesh, coming on to you in terms of the challenges that we discussed, could you elaborate on some of the major challenges faced by the new fund houses which are trying to establish themselves in the industry? And how can a new fund house achieve scalability and compete effectively with the established players?
So as a new fund house, there were not challenges. See, because we are in a service industry and we are probably the last, So we have learned everything from all our predecessors, the good things, the bad things, and therefore today when we are here, so we have studied entire landscape, and actually the whole and the law is also well evolved, regulations are also well set. So the life is very easier for a newer fund house to set in, and his focus will only be to deliver that alpha for the investors. The rest, everything is set. So I think it's an advantage in the service sector industry when we entered late in the game. As far as to increase the investor base, to increase the geographies, I think we just have to be patient. There are 7 crore odd incremental pens that are trading on stock market, options, derivative. Sooner or later, 5-10 years down the line, they all will be on the mutual fund side. So I think we just have to do the right things and focus on delivering alpha for investors.
Be patient and keep on doing the right thing.
Yeah.
That's how it will change. Right. Yeah, Chirag, coming on to you, we have seen a stark change in the overall investment patterns pre and post COVID. And I think some of it is also due to what kind of campaigns we have seen as a mutual fund sahi hai, and the prevalence in terms of lot of influencers talking about mutual funds and making it much more attractive to the common people to invest. So anything which you want to highlight in terms of the investment patterns pre and post COVID?
Sure. So no doubt we have seen an influx of money flowing to equity funds. At one point in time, there was a lot of euphoria surrounding the passive funds, for example. From 17 to 19, in that period, if you see, index performance was very polarized, or market performance was very polarized. A few stocks were driving the performance in the index. And hence, people said that, active mutual funds don't really, generate alpha, for which they are what they're supposed to do in the first place. And hence people said that, let's move to passives. But given the broad rally that we saw post-COVID, we've seen that active funds have started doing well again. And again, people are shifting from what they thought passive was the, next big thing towards getting into active funds again. So I think that is the right way to look at it. And I think we are moving in the right direction. I think the MFDs are giving the right advice and channelizing funds to more active products as opposed to being in the passive products. So that's a good move. Second thing that we are seeing is a lot of acceptance of hybrid products, right? Solutions that mutual funds provide. And that is also, I think, one good thing, because, you better are going and advising your clients and getting them into these products. You are resolving two issues. One is at the client level and one is for yourself, because you don't have to go and reinvent the wheel and say which asset allocation at this point in time is better. Mutual funds are there who are doing it day in and day out, and therefore I think that is again a thing that we are seeing, which is of immense importance to the industry, to the mutual fund investors, and probably relieves the mutual fund distributors of the task of suggesting a right asset allocation. So we're seeing these two big trends that we are seeing, and a lot of acceptance in terms of, or a lot of knowledge that is being shared across the spectrum, right from manufacturer level to the distribution level to the investor level. That pass-through of knowledge has been significantly improved for investors to understand where they are investing, what is the risk they are taking. So that has improved significantly. And I think in terms of numbers also, we are reflecting these trends, right? Passive suddenly from 1% in 2014 went to about 17% in 2023. Now again it's languishing around 16%. So the growth that we have seen over the last 2 years has largely been into active. And I think that is the right trend that we are seeing. And also diversification has been accepted as a very good way to invest. And that is where we are seeing. So acceptance of products like gold, or be it REITs, or many other products that make that asset allocation complete, is the trend that we are seeing across in the industry.
That's interesting. So basically we are seeing that post-COVID things have actually changed more towards the active side, and that's how the market has also moved. I think that is interlinked, and that's how it has, the industry has also moved beyond.
Yes, and on the active side, there is a acceptance that people are under allocated to equities, and therefore increasing that allocation. Like in the 1980s, if you see, equity allocation of Indians was much larger than what it is currently.
True.
It had dipped to 3%, less than 3%. Now it's again come to 5-6%. So we are moving in the right direction, but I think as MFDs who kind of advise clients, you all need to be cognizant of the facts that at some point there will be risk. Like for example, today there is a valuation risk in the market. At the same time, there is capacity risk. For example, a small cap strategy has a particular capacity given the liquidity in the underlying stocks that it buys into the portfolio. And hence you need to be cognizant of the risks that prevail in that small cap space, and you can't just be an asset gatherer because flows are moving into that. You have to manage it wisely and give a transactable NAV to the investors.
True.
If you are taking a liquidity risk, you are not making that NAV a transactable NAV, which is your fiduciary to give to your investors.
True. Right. Coming on to you, Sheila, what Chirag just mentioned in terms of India still being slightly under invested in equities. So there is a risk perception in the market. People perceive mutual funds or equity as inherently risky. With your expertise, especially on the alternate asset classes, how do you see that to be, how can we elevate that perception, and how can we improve the perception about mutual funds in the market to make it much more attractive and much more, penetrative?
Sure. So, from morning we are talking about risks, diversification, and, how a portfolio construct should look like. Now, what happens is, the equity markets have rallied for most part of this year. A lot of it is also because clients or investors are having this FOMO effect, fear of missing out. If somebody else is making money, I also want to make money, and let me make money, just by putting in, funds into equities or, mutual funds which have a greater allocation maybe to equities. But I think one thing needs to be remembered is that you can't put all your eggs in one basket, because when markets crash, it is beyond anybody's control, then to step in and protect their portfolios. So if you want to mitigate your risks, the alternate asset classes like gold actually just do that. We had seen, during COVID and just before COVID, a lot of people buying into crypto, and people have actually burned their hands by investing into such a riskier asset. So what we would like to tell clients, although I'm not a financial advisor, is the fact that the more riskier the asset, the more you should think of having gold or gold ETFs in your portfolios, because when things go down, then the only asset class that can protect your portfolio is something like gold. I also showed it on my presentation in the morning today, where when equities do well, gold does well, but when equities crash, we have seen that the only asset class that gives you that cushion, the insurance for your portfolio, from gold.
Yeah, that's correct. As in, it's always better to diversify your assets and be safe in terms of various fluctuations in the market.
Absolutely.
Sure. So Jitu, coming on to you, in terms of the factors, both internal and external, what do you believe are the most significantly impacting the performance of mutual funds, and what does the industry needs to do to prepare against these and ensure consistent growth?
So factors like change in policy, taxation, or maybe any regulation done by government, the other external policies which impact the performance of the mutual funds. So internal policy like change of portfolio manager, or maybe change of strategy of the investing. These are internal policies which impact the performance. So to make it sustainable, the growth is sustainable, we should the organization should look to give as a long term, to give a proper vision for the long term.
Okay, fair. Fine. Anuj, coming on to you, There has been a consistent investor demand in terms of new products at lower cost. That's ongoing. People keep on asking for that. And SEBI recently also came out with a discussion paper on high risk category. So any suggestions on the new products which can be offered and which can generate consistent investor interest and which can help the industry keep on growing at a good pace?
See, we have almost completed 40 years on this capital market, and as per the SEBI paper, we noticed that as per the SEBI paper, that 70% intraday traders are losing the money, and out of 70%, 48% are below 30 years. So this is the point where we should look after that. We should educate the Gen Z persons or below 30 years person who invested in the market. We should say that you should carry your money in two parts. One is investment and one for the trading perspective. So these people are not, have a knowledge regarding the hedging, how to hedge the portfolio, how to, hedge their investments and how to protect the wealth. So if they are not able to make a wealth from the market, I think they will be exit from the market. So it is a little bit concern for us ki we are not able to provide the education in that kind of person, as our AUM is above 60 lakhs crore. So this is a point where we are focusing on. So SEBI is on the right path that they are doing that kind of activity, but yes, definitely this is our also responsibility to educate this kind of person to invest in that product. And I'm 100% agree with Sheila ma'am that if somebody invests 100 rupees in the stock market, so I think they should 10-20% in the gold, because this is a product where you can hedge your portfolio, and at the time of uncertainty they can use the gold as a money, as a coin. So I think as a whole we should launch that kind of product, and that kind of PMS, you can say a very small ticket kind of PMS. If somebody wants to earn the money from the market and somebody wants to manage the portfolio, so we can launch very short ticket size of PMS, 50,000, 1 lakh rupees, that at least these persons who are new in the market, they can use that kind of services to manage the fund. Because right now we have 10 lakhs, more than 10 lakhs kind of PMS. So I think we should launch that kind of low cost product that still the new investors, that these will come in the market to manage the funds.
Sure. So basically we need to focus more on the beginners who need to attract to the market, yes, and offer products which suit their preferences, their interest.
Absolutely.
That's
absolutely.
how we need to look at it. Right. Rohit, coming on to you, something which has led to this much more growth in the mutual fund market is SIPs, and SIPs have grown at a very strong pace. But we also see that the market is volatile, as in we have seen some kind of volatility this week itself. So what kind of steps do you think can be taken to ensure that this SIPs remain much more sticky and we don't see too much of variation in their inflows and they keep on growing? How do you see that, and what's your suggestion on that?
See, basically, my suggestion is that investment has to be goal-based. You should keep goal in mind. And as a product, mutual fund has always given historically better return in a long run. Now here the catch is when 2020 happened, that is Corona, SEBI immediately told all the mutual fund to give a facility to stop the NAV, SIP. Then what happens if regulator is saying give a facility to stop the SIP, then there is a fear factor. Otherwise, the investors were very calm and quiet. When they came to know that SEBI is saying stop the NAV option we should give, then they said there must be something, whereas there is nothing. So these are some of the points which regulators should think before implementing. Otherwise, SIP investors
but
are...
Rohit, regulator may have its own reasons. Let's not get into that, because
No. I am saying stickiness which you are saying.
True.
So these are some of the reasons. Then second thing is MFD. When they are meeting the investor and they are explaining, during this volatility time, they should do hand holding, and they should, if it is a short term goal, then you should withdraw. But if you have a long term goal, sky is not going to fall, whether market falls by 10%, 15%, 20%. You are a long term investor, you will get good return.
So basically, role of the distributor becomes very important
Yes,
over
very-
here, because ultimately these inevitable shocks will come in between. That's the nature of the beast. So the distributor has to handhold and ensure that the stickiness continues. Right. Umesh ji, coming on to you, something which has impacted the overall industry and the investment patterns of the mutual fund managers is the implication of the removing indexation benefits for the debt-oriented schemes, and this would definitely have some impact on the investors and fund managers. So, how do you see investors should adjust their strategies in light of these changes? And any emerging trends or innovations in debt funds that might impact their performance or attractiveness to their investors?
See, in general, if I am an investor in debt, I am not going to change my focus because there is a little bit change in taxation. Or if I am an equity investor, I am also still not going to change if there is increase in the taxation, etc. So the whole idea is in India, because the debt, the cost of money is at 6.5% is the repo rate. Tomorrow, if repo rate reduces by 300 bips, 2.5%, 3%, half of year people sitting here will become an entrepreneur and they will start their own industry. So the vibrancy of debt market will increase once the interest rate is sharply down, and then we will have a whole lot of exotic products on the debt side. People will, fund managers will have a lot of opportunities to get into, because the cost of money is high. We have limited options and our debt market is really, but I think the trend is there because of our, I think things are moving better. India being a resilient country, more and more flow will come to India, and that's how we are going to get better and better. If US can borrow at 0.5%, and that is why USA has become, is the first largest economy from 1950s to 60s and 70s and 80s. Next 20-30 years, India, if we are able to borrow at 2.5-3%, I think there is massive growth opportunity.
There is no reason it should not happen.
It should.
Are looking all set.
It should happen.
Yeah. Great. Chirag, looking ahead, what do you see as the most promising opportunity for growth in the mutual fund industry, and how should investors and fund managers prepare for that?
Yeah, so biggest growth opportunity is in front of us, right? And it's happening in that way. Equity markets are still very, very underpenetrated when it comes to allocation. So I think equity markets is where the allocation should be. But when you're doing that, right, what we usually see with investor portfolios is an inverted portfolio. So generally when you're constructing a portfolio for your clients, usually safety element was something which is safe, which is a margin of safety, etc. That should be the bulk of the allocation within equities. Then you add mid cap, small cap, venture, startup, etc. And that at the top is the most riskiest and most smallest allocation that you should have. But when we see portfolios or talk to investors or talk to many distributors, they also tell us, give us a feedback of their client portfolios. It's inverted portfolio. The safest element is at the top, and the most riskiest is the bulk of the allocation that people have. So that is one thing that we need to avoid if we want to ensure that money moves in the right, because there will be corrections. There will be corrections on the way. We have seen time and again people panic because of the losses they see on their statements, and therefore they run away from equity markets for 5, 6, 7 years and then come back again in the next bull market. So if we don't want to have that happen, the portfolios have to be constructed in the right manner. Don't go behind fancy things. The best investments are the most boring investments you will get. And therefore the large cap-ish, safe margin of safety, etc. are the best investments that you will make, and they are not bad investments from a return perspective. Large caps are still capable to get you 14-15% long-term returns from your investments, which is not bad at all. If you compound your wealth at 15%, you're achieving most of the goals that you want. True. And hence that remains one of the biggest opportunity that we see in front of ourselves.
Basically keeping it simple, that's what.
Keeping it simple, yes, and boring. That will yield you the results, but at the same time the need for diversification is also very, very important to keep into account when you're constructing portfolios. For example, addition of things like gold, for example, because when equity is the bulk of your allocation and when equities does not do well, gold is something that will do well. Like, for example, global financial crisis. India had nothing to do with that global financial crisis. Markets crashed by more than 50% in that year. Gold was up 31% in that year. So you need such elements which kind of help you, protect your portfolios and therefore construct a good wealth creation journey for clients.
True. So basically keeping it simple, diversifying the portfolio.
Yeah.
And that's something which will lead to much more sustained growth momentum and stability.
Yeah, exactly. And don't really chase returns or momentum, and don't chase fancy things, because that is something which is less understood, and that will lead to not the outcomes that you're looking for.
Basically short term it may be beneficial, but long term you will definitely.
Yeah, and there is no surety of that, right?
True,
and this is a sure shot formula to making wealth. Why not?
Why not? True. Great. Sheila, coming on to the interest rate cycle, we see interest rate cycle is right now at the peak, and although in India we saw yesterday nothing changed and the rates remain where they are, but we expect some kind of a change at US Fed level. So do you see that impacting the overall market in any way?
Yes, I think it will, right? Because it's all about opportunity cost, the cost of holding one asset versus another. So, for example, if the Fed decides to, reduce interest rates in the next quarter, and if RBI also decides to follow suit, then there is going to be flight of money from the bond market to some other asset class, and which could be very well be gold, because gold has no counterparty risk, so to say. It's nobody's asset in that sense. It doesn't belong to a particular government. So from that perspective, should the interest rates change and move to on the downward side, we definitely see some uptick in gold demand.
Okay. Yeah. So basically gold demand will remain firm with the kind of taxation changes which have happened in the budget. So I think that will continue. That's what we are seeing.
Yes, we are expecting the same thing.
Sure. Great. So, Jitu, coming on to you, in terms of the mutual fund industry, it operates within a regulatory and a legal framework. So, and a lot of changes keep on happening. The industry keeps on evolving with the changes in laws and taxation rules. So, how do you see the mutual fund managers adapting to this, and how do you see the preparedness in terms of how to handle these kind of changes?
So, as you know, the mutual funds are regulated. We have to follow all the guidelines, the framework. So any change, which impact our decision making, so in case of any policy change, we have to implement the same in our internal and external policy. And so, this is how we have.
Okay. So basically we always need to be on our toes, because things keep on changing at a very fast pace, frankly.
Yeah.
Then every year we are seeing some changes which is impacting the overall ecosystem.
Yes.
True. Anuj, we just heard the regulator speaking before the panel discussion, and there was this discussion on taking it to the lower level and much more, sensitization of the investment. So we have seen a trend in our report also. You will see that there has been a consistent change in ticket sizes. Yeah. Those ticket sizes actually have been rising, and the investor profile is also changing. So any specific product strategy which you would like to think that industry needs to adopt to tap to this potential and this pattern?
See, as I am coming from the commodity market, so my perception is always towards the commodities. So we have only the gold ETF, which is increased significantly in last 4 years. The AUM is almost 36,000 crores, which is increased from 5,000 crores. So we should have more commodity specific ETFs, just kind of crude oil. Crude oil is the global commodity, but we are not able to still launch crude oil ETF. So if we are able to launch that kind of product, which will be liked by everybody, even equity person is also looking the crude oil prices. So, and even one important thing is that crude is a product which is liked by everybody, and every equity investor, debt investor, government, all are looking toward this product. So we should penetrate that kind of product which is looking by everybody. So I think as an industry or as a the government, I think we should be looking toward that kind of product which is look and liked by the every investor, and which is affected all your investments. So I think crude oil is a product where we should look after to launch the ETF. Natural gas definitely is the product we should look after the product. And the important point is that on MCX, 80% volumes comes from the crude oil side. So if we are contributing that kind of volume on MCX and everybody is looking, so I think we should look towards that kind of product where people are hedge their portfolio. So hedging kind of activity, I said in an earlier conversation that the awareness towards the hedging policy, hedging perception, hedging strategies, which is missing in the investor. So I think we should look towards the hedging kind of product by commodity or by other product. I think that should be there.
Sure. So basically we have the options to offer new products and which can lead to sustained kind of a growth, right? Rohit, coming on to you, one thing which has been the talk of the town over the last few months is that banks are facing some stress on their deposit profile, and they are finding it tough to raise deposits to match with the credit growth which the industry is seeing. So how do you see that, and do you see that there is some kind of challenge which the mutual fund industry may face from the banks in terms of their quest to raise more deposits? Do you see them as a competitor?
You are talking about debt, correct?
Yeah.
In 2012, the contribution of debt in the AUM was 69%. Today it is 23%.
Right.
The reason behind this is, again, I will come back to regulator. Dividend distribution tax was imposed, then 3 year for short term, and now something new has come up, indexation will not be given. So yes, as a MF, we can contribute to the debt capital market in a big way, because India is not the story of this a decade, it is a story of 100th century. Youngest population, and our service industry or cost of labor is better than other developed country, I will say, developing country nahi. So what we are aiming at 2030 mein third economy, for that debt will play a bigger role. So for that, investor education, while we are doing mutual fund sahi hai, 90% people understand equity only. So
it's more of an institution thing.
Yeah. So normally debt में क्या होता है कि वो बड़ी टिकट के
इंस्टीट्यूशन हैं 16 लाख का,
तो रिटेल उसमें नहीं आ पाते हैं.
True.
तो जब तक रिटेल पार्टिसिपेशन नहीं होगा, helping the growing economy will not be possible.
Okay. Fine. I think we are on dot in terms of time. I think we are just having some minutes left. So I'll now open the floor to the audience. Any questions which audience want to ask from our panelist?
Sir, what is SWOT, means SWOT analysis of a mutual fund, where S means strength, W means weakness, O means opportunity, and T means threat. What is this SWOT analysis?
Anyone wants to take it?
So the biggest strength of the mutual fund industry is the good regulations. It's very well regulated industry that we have. That's one of the biggest strength. Other thing is, from a strength perspective is, it's very, very liquid instruments that have been created for investors. It is very, very accessible for investors. So all these are, I think, pretty good strengths which are unmatched. And as I said, taxation is one of the biggest boon that mutual funds provide to investors. And the plethora of products that are there. From an opportunity standpoint, I think there could be a lot of innovation that we can see from the industry, which can help, provided regulations provide that boundary for, again, because regulations can act in both ways, right? One is tighter regulations for the safety and security. At the same time, it can, curb innovation as well. So currently, we need more space for innovation to some extent. But probably it will come at the right time. Maybe markets still have to gear up in the right direction and allocate in the right way for that innovation to kick in. As there is more acceptance of the and understanding of the risk of the market and instruments, probably regulators will allow that at the right time as well. From a threat perspective, I don't. Yeah, I think the short-term thing that we see in a way in terms of people moving to futures and options, etc., misguided, that may completely make them go away from the market as opposed to bring them in the market and invest in a sensible way, which is a big threat that I see within the industry. Plus the mentality, sometimes there is a mentality to just gather assets as opposed to, for example, to give you example in the small cap space, right? In the small cap space, probably, there have been stress tests, there have been a lot of things, but when you look at the liquidity, given the size and AUM of many funds, they will take around, 200, 500,000 days even to liquidate many of the holdings that they have in the portfolio. Is that something, so as it's said, as the tide goes away, people know who is swimming naked, right? It's that kind of thing. So whenever things are going in the right direction, you know that, it is easier for anyone to accept because that eventuality in terms of liquidity crisis has not come out. But when that comes out, probably there will be a bigger risk that could unfold, and hence you need to be true to your mandate in terms of what capacity, because every factory, every strategy has a capacity and it has to be adhered to that capacity constraints, otherwise you are taking an additional risk with your investments.
Sir, weakness, please focus on weakness also. What is the weakness? W?
Weakness is the inability to reach 140 crore people, right? I think as we have more MFDs, more reach, etc., that will help us reach nooks and corners of the country and have many investors into the fold.
That is opportunity also.
Yes, that's an opportunity as well. So many things have two sides.
Excessive regulation is also a weakness.
Great. I'm sure still there are a lot of questions in our audience mind, but with the time constraints, we need to close this session now. Great. It was a very pretty insightful session with our panelists giving their unique perspective on the mutual fund industry. Thank you, everyone, and thanks for joining us.
A round of applause. Thank you very much for a very informative session. Thank you so much. Please come together for a group photograph. Thank you so much.